Hello everyone, let me take you through the debt market update for this month. Now starting with the update on global interest rate environment. In US, the CPI inflation for May 2023 came in at 4%. However, the core inflation was higher at 5.3%. The FOMC decided to pause on rates in June 2023. However, given the strong job data and slow pace of disinflation, the Fed dot plot indicates two more hikes during the calendar year 2023. According to us, July 2023 is a live policy and monetary action would be data dependent. However, post July 2023, we believe lower inflation readings should result in Fed staying on hold for the rest of calendar year 2023. We expect the Fed pivot to get delayed towards the end of the year or starting early next year. In the month of June, the US 10-year yields have jumped up from 365 to 3.87. Bank of Canada, the ECB, Reserve Bank of Australia have raised rates by 25 basis points each in June 2023. Bank of England raised rates by 50 basis points higher than the market expectation. The forward guidance of these central banks indicate likelihood of further monetary tightening in order to control inflation. On the other side, China Central Bank has lowered short-term lending rates for the first time in 10 months to restore market confidence and to give boost to the post-pandemic recovery. On the domestic front, currently India is in a sweet spot with RBI FY24 inflation pegged at 5.22% and GDP pegged at 6.5%. In the June policy, RBI decided to keep the rates unchanged and also maintained withdrawal of accommodation as the monetary policy stance. Post the RBI policy, inflation numbers for the month of May 2023 were released. The inflation number came in at 4.25%. Now, barring El Nino risk, inflation for FY24 is likely to undershoot RBI's inflation forecast of 5.22%. At 6.5% repo rate, based on the FY24 inflation projections, real policy rates are in the band of 1.25 to 1.5%. We expect RBI to stay on hold for rest of calendar year 2023 despite narrowing interest rate differential with the US Fed fund rate. We expect RBI to change the monetary policy stance towards the end of calendar year 2023 and RBI to begin monetary easing in first half of calendar year 2024. As a part of clean note policy, RBI on 19th May 2023 decided to recall the 2000 rupee bank note of around 3.62 lakh crore. Now, within a month of the recall order, approximately 2,70,000 crore of 2000 rupee note have come back to the banking system. The currency in circulation is down by approximately 1,10,000 crore, which has resulted in increase in the banking system liquidity to that extent. The yield curve is currently flat with the 1-year 10-year G-Sec trading in the range of 690 to 710. We expect yields to trade in a narrow range in the near term and then a parallel downward shift as expectation of Fed pivot and RBI change in monetary policy stance increases over the course of next 3 to 6 months. We expect the yield curve to steepen once RBI actually start cutting rates. Given the view that rates have peaked and expected to trend lower over the course of next 6 months to 1 year, investors can consider investing in longer duration funds, dynamic fund, banking PSU fund, and medium-term fund. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.